Hi, and thank you for joining us for today's webinar. My name is Mike Ratliff. I'm with Hunt Real Estate Capital. I'm going to just be doing a little bit of housekeeping and introducing the panel here. Our webinar, How Will the FHFA's New Cap Structure Impact Multifamily? Everyone on this call today will receive a recording of the webinar to the email address that they used to register. Will come tomorrow. At any time during the webinar, we encourage you to enter in a question for the panel. You can do that on the bottom of the control panel in the questions tab. Joining us for the call today, we have James Flynn, President and CIO at Hunt Real Estate Capital, Michael Winters, Vice President of Lender Relationships, Structured Transactions, and Small Loans at Fannie Mae, and Peter Giles, Vice President of Production, Freddie Mac Multifamily. I'm going to pass it off to Jim just to tell everyone a little bit about Hunt, and then we'll get things started.
Thanks, Michael, and thank you to Mike and Peter for joining us today. We appreciate the time that you're giving us and to our employees and clients. For those on the call, just a quick overview of Hunt for some of you who might not know us as well. We are a national lender focused in multifamily, but participate in all of the products that Fannie and Freddie have to offer. We also provide financing through FHA and on our balance sheet. We have an almost 50-year track record, 60-plus production officers across the country, 25 offices nationwide, and have continued to grow here with both Fannie and Freddie over the past 5 or 6 years, and anticipate another growth year here in 2019. I'll let Mike introduce himself and then Peter, and then we can move along through the materials.
Sure, Jim. Thank you. Thank you very much. Yeah, my name is Mike Winters. I'm a vice president in the customer engagement unit of Fannie Mae's multifamily division. My teams and I manage about half of the 25 DUS lenders. And we have the good fortune to manage the Hunt team, which is obviously one of our favorite lenders that we deal with every day. I also manage structured transaction team, small loans, and senior housing group too. So thank you very much for including me. I look forward to the session.
Great.
Yeah, and thank you, Michael. Yeah, this is Peter Giles, Freddie Mac. I co-lead our production efforts at Freddie Mac along with my colleague Rich Martinez. Under Rich and I's umbrella includes senior housing, our structured group, our small balance loan group, covering states coast to coast. And as a side, Mike Winters and I, this will be a very friendly with both GSEs on the phone. Mike Winters and I are longtime friends that have known each other for over 25 years. So if you were looking for a match, a wrestling match in the middle, you're not going to get that today.
That is correct. That's correct.
We'll do that. We'll get that next time. I guess just to get into it, I think the overarching question, as we discussed shortly before the call, I think we've all answered this question to a number of folks. I'm guessing Peter and Mike have done so more than most of us. But if you look on slide 6, this was a poll as of this morning or yesterday afternoon for those that registered, just asking them what they thought the FHFA scorecard and changes made, what the impact would be to the multifamily market. As you can see, there's a very large percentage that are still kind of trying to feel out what it means, 40%, the biggest single block. There's a 7% that believe it's negative, and then you see the rest falling out through neutral or positive. I for my own view, and I'd like to hear obviously from our panelists, but I was encouraged by the scorecard when it came out. I think we had all lived in a shadow of uncertainty for quite some time, and I think it was wearing on some of our ability to conduct business and just general fatigue of not knowing what the industry would look like going forward. I think FHFA's scorecard came out and supported the view that the agencies are an important part of the industry, that their size is acceptable to the regulator and not looking to do something dramatic in terms of changes there. And then, also, I think refocusing the general view of the importance of the mission of both agencies. So overall, I thought it was a positive. I think it allows the agencies to, maintain. If the market grows, I think it leaves open the ability for the FHFA to step in and make changes. Of course, that could go both ways, but all in all, I think given the last couple of years and what we thought might happen, I thought it was a positive. But forget who went first. The first time, I guess we'll start maybe with you, Mike.
Yeah, I would echo a lot of your same comments. I do think, and we were joking a little bit before the call started, the poor person that followed Mark Calabria when the announcement was made was the audience was empty because everyone was out in the lobby on the cell phones, really relaying what we would call as very good news, right? For the folks of us who have worked in this industry for a while, or even if you guys have been borrowers for a long time, right? We've been under a lot of uncertainty for really the past 10 years. So the announcement really provided a lot of clarity for us, a great roadmap. I think it did validate what Jim had said, our place in the market and how critical we are to this industry. So overall, we thought it was a great announcement and well received by, I think, the industry. Peter, I'll turn it over to you if you have comments.
Yeah. Thank you, Mike. I can't tell from the survey if the negative response is that it's too much or too little, or at the Goldilocks just right level. The story this year really goes to late April, when the facts are, at least from the Freddie Mac perspective, is we were running really, really hot. The drop in the Treasury spurred a tremendous amount of inflows. We started, typical week, we see about $4 billion in opportunity. We started running in March and April at about $6 billion a week. And our conversion rate was really high because of the drop in the Treasury and shifting what we typically see, which is about a 50-50 ratio of acquisitions to refis to 70% refis. So people were rushing in. We were in a capped environment, and we were concerned about hitting our cap. And then we pivoted from May to really the announcement on September 13th in trying to do our primary mission, which is to keep liquidity. So we welcome the news a great deal. It gives a excellent roadmap. I think it is the Goldilocks level. It's just right when you think through the size of the market. So the market has continued to grow. Jamie Woodall at the MBA released on September 10th that their prediction for the 2020 market will be $390 billion in transaction. If you look at, on a 4-quarter basis, the regulator's announcement, $80 billion each, that puts us roughly over 41%, which feels right. And I think from my perspective, it feels right because it assures, if we manage our job correctly, that you'll have liquidity in all 4 quarters. And also to think through the fact that with the large increase in market, can other lenders step into the space? So you're talking about $60 billion up in the transaction market. Can CMBS fire it up and cover $60 billion in 2020? Can life companies increase their bid? Can banks? Can debt funds? And I think that gap and having us solidly at 80 each makes real sense from our perspective. So we welcome the news. Our tone is very positive. It was terrific news we got on the 13th.
Thank you guys. Before we get into a couple of more specifics as to the framework of the scorecard, just a quick question on yesterday's announcement around retention of capital for those that didn't see. FHFA and Treasury issued I guess a joint statement or an announcement that Fannie and Freddie would be allowed to retain capital above the $3 billion mark, which is what it's been at since being in conservatorship, and so that money would no longer be distributed up as a dividend to Treasury. Obviously, the signals from FHFA, the administration, Treasury have been a desire to remove the GSEs from conservatorship. In order to do that, there's a significant amount of capital, of which this is, probably, a reasonably small percentage. But is there any, you have any thoughts on that? Is it as expected, or read anything further into that?
This is Peter. I'll jump on that first. I think in our halls, this news was as welcomed, if not more, than the September 13th news. It has been our objective and hopes for these 10, 11 years to get back to being a privately owned company. And this is the first step. I compliment the director on moving this quickly and getting it done. He promised by the end of the third quarter, he delivered. It's good news, and you're right. It's a fraction of what we'll need to be private, but it certainly begins to make us more attractive to be private when we start to hold that capital. So really welcome news at Freddie Mac. Our objective to restate is to get out of conservatorship. All that pivoting I just talked about that we did from May was in large part due to the cap regulation, and as a private company, I don't think we would have that. So welcome news.
Yeah, Fannie Mae's perspective would be the same. I think the timing was great because things generally don't move that quickly. So to have something kind of publicly out there and delivered on time, I won't comment on the $25 billion, but again, same theme as from the first question. This just provides us a little bit more certainty, a little bit of a path forward about something we've been waiting for a long time. So again, incredibly great news for us.
Yeah, and for others, I mean, the key here, aside from just getting out of conservatorship, right, is we've all been living with, and you both in the organizations have been living specifically with, headline risk and not wanting to find yourselves in a challenging position with respect to capital and losses, and not able to retain earnings and have to distribute all of your cash up to Treasury, left virtually no room for any margin of error. And the last thing that we all need in the industry is for there to be some speed bump along the way where either Fannie or Freddie or both experience some loss, while significant, not necessarily needed to be massive in order to create disruption that would require having to go back and ask for more money. So for those of us out here, I think looking at this first step was very much a positive in avoiding that pitfall as we move towards something more permanent and stable.
Exactly.
So I guess I would like to maybe turn a little bit to the green financing aspect of the scorecard. I think that's probably the single most frequent topic that I've been asked about, which is, with green financing having been such a significant component of the uncapped portion of the business that's been done in the past, and the elimination of that, that from the mission rich target going forward. One, how do you each view that as impacting your overall business levels, and secondly, I think probably more importantly for many of the folks on the phone, how do Fannie and Freddie intend, if at all, to continue to support green financing in any way? Maybe Mike, you can go first on this one.
Yeah, sure. I think the impact on volumes is probably a story to be told, because as Peter kind of alluded to, the size of the market, there's going to be plenty of volume out there. And we certainly have a kind of a scalable market to kind of meet kind of the market needs, or a scalable model to meet the market needs, So, but in generally with green, and no uncertain terms, our company's still going to be committed to green, whether it's defined as mission or uncapped or capped, whatever it is. We were really on the forefront of this business. Believe it or not, our program's now 9 years old. So we did this well before it was kind of an exclusion play, because we really kind of believe in it, right? We believe it in the multifamily side, and we believe in it corporately. Ultimately, we think green is good business, right? It extends the life of property. There's money going back into older housing stock. So all those things are really good things for us to do. So we're going to have to kind of figure out what that means specifically, right? Or are there changes to the program? Potentially. But that's something we're having. There was even a call today, right before this call, about things like, what are we going to do? Are we going to do things differently? But, again, it does provide the benefits of a green program to both agencies. I would assume it does provide a lot of housing units, which those goals still remain in place for us. So just the nature of the green product, it's kind of beneficial in other ways besides green. So you'll see us kind of continue it. There may be some tweaks to how we do it, but it'll be an important part of our business. Will we do probably the levels that we've done before? That'll probably be harder to achieve, but you'll see that as a important part of our business going forward.
Similarly, we're in the lab on it. The fact of green is that we were subsidizing it, and we were subsidizing it in the reduction in spread because we were getting uncapped treatment. So as we think about our obligation to the taxpayers, as we think about getting out of conservatorship, subsidizing something we're not getting credit for doesn't make a lot of sense. Now, on the other side, we share much of the sentiment Mike just portrayed with Fannie. We believe in it. We think that if you're doing energy improvements that are in unit, you're reducing cost to tenants, and we like that a lot. We think that's part of our mission. We've invested financially in the product. We have traded our first large bond a few months ago. We're out to market, I think, in the next few weeks with another. We've drawn in more investors for that. It traded well. So we like the product. We're in the lab trying to figure out the price of the product. And last year, I can talk about last year's number, we did $23 billion in green. In 2020, we're not going to get near $23 billion in green. Our securitization pool was $500 million. I think it'd be terrific if we did 10 pools next year, or $5 billion of green business. But that is the change, unless we can see through the subsidy and make the subsidy make sense. And that's much a market decision. how those bonds trade. If there's real interest and an actual subsidy there, then I think we'll relay that over to you, the borrowers. But until we solve for that, we frankly can't afford it. So it will be different for sure.
And Jim, that is an excellent point. That is just one thing that Peter said I want to highlight, which is right, is in terms of our view and our support of it, is we do want to continue to support to make sure it is kind of accepted by the marketplace, and then ultimately kind of potentially have a better execution with green. That's always the hope for that program. So you have to have a certain level of activity to kind of keep it out there and keep people interested and keep buyers interested in that product.
Yeah, no, that's it's an interesting point as we approach what is certainly a volatile and divided election season. There's a lot of discussion from many candidates about how much responsibility corporations have, public and private companies to citizens, period, as opposed to just shareholders. And I suspect that there will be more pressure on large financial institutions to continue to do things that are politically acceptable. And while there's always debate about who should pay for environmental reform, I think there's typically plurality support among everyday people that if something can be more green than less, then that's a good thing. So there probably is a real opportunity on a go-forward basis, maybe not in 2019, but as we move into 2020 and beyond, that there will be significant pricing impact on green because of the political environment as opposed to the regulatory environment.
Yeah, that could be right.
One of the other areas that the scorecard focused on was manufactured housing. It's really the only universally excluded asset type, and just curious if that's had any impact, or if it's too soon to really comment on the business activity. Certainly policy-wise, I think we can all see how it makes sense, but curious if there's what you've seen in the manufactured housing space or expect to see.
I think from our perspective, it's status quo. I think the GSEs provide, I'm going to guess a number here, about $3 billion of financing annually. It's sort of flip-flopped the last few years as to who's done more of us. It's an $8 billion a year market. So I think that $3 billion number fits in nicely as to the regulators' expectations of our share, our combined share. We like the space. We're newer to the space than certainly what Fannie has done, but it's performed really well for us. And I think it will be status quo. I think we're targeting in 2020 what we targeted at the start of this year.
Yeah, Fannie's perspective, it does seem status quo, and it's too early to tell what it will ultimately mean with scorecard. But if you look, I think for us, probably 2 years ago was a bigger spike in volume. So 18, 19 kind of been at those levels, but no real kind of increases. I think there are new entrants into the market, some institutional type money coming in, some bigger pools being done. But again, that was in 17, 18, 19, I think 2020, again, expect to be kind of flat. The market's only so big, as Peter talked about. There's not a lot of new manufactured housing communities being developed, obviously. So the market is what it is, but it's a space that we're comfortable in. It has performed very well for us also. So we continue to be kind of active in that space.
So both, at different times, Freddie certainly had significant growth in the small loan space over the past several years. Fannie going back before that, and I think Fannie has a renewed focus over the last couple of years to do more in that space. Just speaking from Hunt's business, the significant majority of small balance loans still typically qualify, under an affordable exemption typically. So call it 75% of small loans probably still fit a mission-rich goal. I don't know if that's the case for everyone's portfolio, but how do you see the small loan landscape given the reduction in subsidy to some level, whatever that might be?
Yeah, I'll go first. This is Mike again. I'll go first, and this is maybe some space we're a little bit different in regards to kind of appetite of the business, right? So we're I think pretty targeted in kind of what we're looking for. There is some duality in kind of what we have to do, right? Because there are kind of the mission goals, right, that are the 37.5%, and obviously the 5 to 50 can play a nice big part of that. And there's also the goals, right? So our housing goals still remain the same, but separate from kind of FHFA's mission exemption. So we still have 10,000 5 to 50 units at 80% AMI. That's a minimum threshold that we have to get to. We have tweaked our program in the last 18 months to be more competitive with Peter's SBL program, which has paid off some dividends for us, at least in the short term. We'll continue to play in that space kind of at a measured level, as we've done for a long period of time.
I'll share a story of competition going back several years ago. The regulator, and rightly so, puts out affordable units that we must do on an annual basis. And for years, we would always be stretching into the fourth quarter, and we would see Fannie's third quarter report, and we go, how the heck did they hit that number so early? And we were pushing through. Then we got in the SBL business. And then we understood the power of that to deliver affordability. And so this year will be our second largest year ever. We've embraced the space. We continue to tweak to try best to understand it for delivery from you, Hunt, and your peers to make it a better and better product. But when we think about that 37.5 and the delivery, I think our average hit rate is plus 80% of the deals coming in the SBL space are affordable. And so we'll continue to be in that market, and we're glad to have figured out that affordability 4 years ago.
As are we. A reminder to folks, if you do have questions and you type them in, they pop up over here. So if there's anything that you'd like to hear, go ahead and put it in. Another question that folks have asked with respect to the $100 billion 5-quarter scorecard. One basic question, I don't know if there's an answer to it yet, but can I assume that we all expect that we're going to go back to a calendar year or 4-quarter scorecard going forward? That's hopefully an easy question. The other is, and I think Peter touched on this earlier, is how do you expect to allocate that? Should people be thinking kind of it's a straight line with maybe some, fourth quarter is going to be bigger than first quarter type of activity, or have you guys given a lot of thought to that already, or we kind of going to see how the market plays out?
I'll lead off. We're still awaiting the final scorecard, and so we're working off the assumption of a couple of things to your question. That the 5-quarter $100 billion is just that. It's $100 billion over 5 quarters, and it's not set specifically to each quarter. But internally, we're working on the idea that we'll do and be disciplined in doing it, that we'll be doing $20 billion a quarter. And we think that's important, that consistency to deliver out to the marketplace, because what we don't want to do is, frankly, what we felt at the 1st of May this year, and that's shooting it out early and not having have the liquidity, which is our promise to you and a fundamental mission of ours throughout the year. So we'll be focused internally on the decisions we're making at $20 billion a quarter.
Yeah, that's Mike again. Yeah, that's an important tenet of kind of what we're required to do, right? Is liquidity throughout the year, and I think that was even in the written material from the regulator about how important that is. Yeah, so it is, it's a 15-month goal, but, the best way to manage that, we feel too, is on a quarterly basis, because it's just as important for us to be providing liquidity in November, December of next year as it is in January, February. So that is a challenge, obviously, because you don't want to go over. You want to kind of land right at those numbers. So, but it's a challenge. Again, we've been living under a cap constraint for 4 years now, I guess. So it's something that we're very, as comfortable as you can be at this point.
Okay. So that's $20 billion in 4th quarter of 2019. I think everyone heard that. I guess the only other thought that I have is just a quick discussion on rates. I think we touched on the impact it's had on earlier in the year, but where is the economic forecasting coming out from the internal views at Fannie and Freddie for the rest of the year and really going into next year in terms of where you guys are at least publicly thinking the market's going with the 10-year?
I'll let you take that one first, Mike.
These are questions I don't answer, especially on recorded lines, Jim. I mean, your guess is as good as anybody's on kind of where we think.
Well, look, I don't have anything else. I don't know if you guys have, Peter or Mike, if you have anything to add, final thoughts, but
Peter,
thank you both
for to you.
Yeah, one thing we didn't touch on that I think you can feel assured from, and I think, Mike, I won't speak from you, but I feel confident in your delivery of this too. The 37.5 is a good number. It's a challenge, but it's a challenge that I think both GSEs, and speaking for Freddie Mac, will meet. If you drop out our green financing this year, we're tracking to that number, and it is because of the other products that we talked about today. It is SBL. It's our targeted affordable group. It's our senior housing group. It's manufactured housing. We see that naturally occurring as it comes in. And so I'm confident that as we look forward, what you won't see is both GSEs scrambling for that, but looking for it throughout the year, which is our mission. I think we're aligned with that mission with the regulator and understand that. So the 37.5% of mission-driven product, I don't think should be a concern. Just an understanding of that's what the GSEs do day in and day out.
Yeah, I mean,
just
go ahead, Mike.
I was just gonna add, again, kind of summary, kind of where we started this conversation off is like we think this is great news for all of us, right? For us, with agencies, frankly, for Hunt, for folks on the phone, right? So this will help us kind of meet the needs of customers, right? Which is kind of what we do every day, and our customers are Hunt and also the end users on the line. And so it's going to provide a lot of liquidity to a very large projected mortgage market, and a lot of stability for the market. I think last comment on the 37.5%, and Jeff Hayward, who leads our group, would not be happy I didn't mention this. Like, our view of that is that's the floor, right? We have to do at least that, but our goal is to do more than that. And we will do that through the various kind of product offerings that we have and the various executions that we have, from small loans all the way to, our competitive product of our structured credit facility group. So, just want people to know that, we are in the market every day and we'll be here for you throughout 2020. Sorry, Jim.
Yeah, and I appreciate that reminder. And for those on the phone that don't know, I mean, Hunt is still delivering, somewhere north of 60%, between 60 and 70% of the business we deliver is mission rich, which at this point really means affordable, because it's small loan affordable, it's targeted affordable, it's manufactured housing. It's something that we're certainly proud of, and is a large focus. And we kind of danced around talking about the cap and affordability without hitting that one on the head. But I think for us, clearly that's a big focus for us going forward. We know it is for the agencies, and we certainly look forward to expanding that going forward. And with that, I will say thank you to our panelists for joining, and thanks for all of those who listened or will listen on recording.
Thanks for having us.